Hello, and welcome back to Insight to Invest, the channel that gives you insight into a company and you decide whether or not to invest. Most of us know Sandisk as the brand on the dusty 6 gig SD card sitting in the back of your drawer. For decades, they were the reliable but boring storage guys. But if you've been watching the stock market lately, boring is the last word you'd use to describe Sandisk right now. In early 2025, Sandisk did something radical. They broke up with Western Digital, went solo, and since then, the stock has gone absolutely nuclear, up over 1,500% in a little over a year. Is this just another AI-fueled bubble, or is Sandisk actually the secret backbone of the next industrial revolution? Today, we're diving into the history, the tech, and a price model to see if Sandisk is a real steal or a trap at its current price. To understand where we're going, we have to see where we started. Sandisk was founded in 1988 by Eli Harari, Sanjay Malhotra, and Jack Wan. Excuse me for the pronunciation if I got it incorrect. Back then, they weren't called Sandisk. They were called SunDisk. The name actually came from Eli's daughter, who thought sun sounded cheerful and sunny. They eventually changed it to Sandisk when they went public in 1995 to sound a bit more professional. But their mission was wild in the 1980s. They wanted to replace heavy, spinning drives with system flash. Imagine telling someone in 1988 that a piece of plastic the size of a fingernail could hold more data than a room full of servers. They pioneered the first SSD in 1991. It was 20 megabits and cost $1,000. Fast forward through the 2000s and they became the kings of the cruiser USB and SD card. But in 2016, Western Digital bought them for $19 billion, and for nearly a decade, Sandisk was just a department within a bigger corporation. So why are we talking about them now? Because in 2025, the Great Divorce happened. Western Digital spun Sandisk off into its own independent company, ticker symbol SNDK, and the timing was perfect. See, Sandisk isn't just making thumb drives for your grandmother's vacation photos anymore. They pivoted hard into the enterprise SSDs and AI storage. This is unique because AI doesn't just need big storage, it needs fast storage. When a model like ChatGPT is thinking, it's moving massive amounts of data in and out of memory. Sandisk's new Optimus lineup and their BiCS NAND technology are designed specifically for these AI workloads. They are one of the few companies on Earth that actually manufactures NAND flash chips themselves. They don't just buy parts and put a sticker on them. They own the secret sauce from the factory floor to the store shelf. Let's talk numbers, because Sandisk's recent Q2 2026 earnings report was just absolutely amazing. They had revenue expectations of $2.67 billion. And they had actual revenue of $3.03 billion. Their earnings per share expectation was $3.49, actual $6.20. Their gross margin was expected to be 30%, and it actually turned out to be 51%. A 77% beat on earnings. That's unheard of for a hardware company. The revenue is up 61% year over year. They just guided for even higher numbers the next quarter, expecting earnings per share to be between $12 and $14. That is incredible. They just came off of $6.20, and their expectation now is $12 to $14. One of the most impressive parts is that they paid down $750 million in debt this year. They aren't just growing, they're getting lean. Now for the million-dollar question. Is the stock too expensive? It's currently trading around $585 to $620 or so. As we can see from this stock chart, they closed today at $584.55, but are up in aftermarket trading to $611. If we use the price to earnings model, things look scary. Analysts say the fair value based on historical hardware multiples would put the stock at about $265 per share. By that logic, the stock is about 100% overvalued based on the close, roughly. But if we use a discounted cash flow model, which looks at how much actual cash the company will print in the future, the story changes. If Sandisk hits its guidance of $13 earnings per share next quarter and maintains its 50% plus margins as AI demand stays above supply through 2026, The DCF model suggests a fair value of $859 per share. So we have a massive gap. The old school analysts think it's a bubble. The cash flow bulls think it still has a 40% upside. Personally, when I see a company with pricing power, meaning they can raise prices and customers still fight over the stock, I lean toward the cash flow model. SanDisk is no longer the SD card company. They are an AI infrastructure play disguised as a consumer brand. They have a monopoly-like grip on high-end flash memory, their margins are exploding, and the AI boom is just getting started. For the bear case, memory is a cyclical industry. What goes up usually comes down when supply eventually catches up to demand. So, are you buying the dip, or is this too rich for your blood? Let me know in the comments. And if you found this breakdown helpful, hit the like button. It helps the channel more than you know. Thank you. See you in the next one. Bye.